If I could give an overview of the UK property market, I think it's important to start the story in 2008, which was the beginning of a gigantic bull run for London, which has seen central London in particular now become a totally white-hot market. The reason for that bull run in the London market has predominantly been inward investment into the UK. Between 2008 and now, over £60 billion of real estate money from the Far East, the Middle East and the US predominantly has been invested in London. £60 billion between 2008 and today. And the reasons for that were really historically low interest rates. The Bank of England moved its interest rates down post the Lehman crash to the lowest level they'd been for 320 years, and they're still there. Pricing had collapsed. Pricing was historically low. It's a combination of low interest rates and pricing. Add to that the fact that sterling was very weak, and that meant that inward investors could make a profit on entry. And you can see really why the UK market became of great interest to sovereign wealth funds, Far Eastern and Middle Eastern, and US private equity houses as the US economy began to recover and the US private equity houses developed high net worth firepower. So they all, as it were, trained their financial lasers on London and they poured in that £60 billion. What's happened now is that London is a white-hot ball of overpricing. It is right at the peak of a bull run. So historic yields in the West End, for example, are back down at 2%, which is exactly the same level as the height of the craze in 2006. The city is sub 5, in some cases down to 4. And in fact, a number of sovereign wealth funds, such as the Swedish National Pension Fund, have actually for the moment dropped out of the London market because it is so superheated. What's interesting is that until recently, that investment boom had not been supported by occupier demand for buildings. But now, with the economy recovering, I think we've now had 6 quarters of albeit modest GDP growth. Occupiers are beginning to look for space in London, so there's now some occupier demand supporting this bull run. So whereas if you'd asked me 6 months ago, I would have said that this London market was ripe for a downturn, I think we've probably now got another 2.5 years of this yet. I would call the top of the market in about 2017 and perhaps a little bit later for residential. Indeed, there is an argument that says that London residential might not come down for a decade or more, or if it does, it'll only be a small correction. But so there's this white-hot ball of London. But what's happening is, with the UK institutions and some of the sovereign wealth having been priced out of that, they're beginning to look for opportunities elsewhere. Opportunities elsewhere both in terms of geography and in terms of concepts. So to take the geography first, the UK institutions have begun to migrate out of London to other major UK centres such as Edinburgh, Manchester, Birmingham, where pricing is still good, where instead of 3 or 4%, they can maybe get 6% for a headquarters building in Birmingham. So it's an absolute no-brainer if they can find strong tenants. So the UK institutions have begun to migrate to these other major UK centres. The sovereign wealth funds have taken a little longer to get onto that beat, as it were. The American private equity houses recognise the quality in the UK regions and they're more flexible. So we've seen Oaktree, for example, buying IQ Winash from Seagrow. It's about 5% of Seagrow's total value. IQ Winash, a giant business park, size of a town, with its own railway station. They bought that for $245 million, and I acted for Seagrow on that last summer. So we've seen the US private equity houses moving out of London and tracking opportunities. The sovereign wealths have been a little bit less nimble, and they've, particularly from the Middle Easterners and the Far Easterners, they're not so driven by returns. They tend not to have pension fund returns that they have to generate. So a great example would be the Kuwait Investment Office, for whom we've done a fair bit of work over the years, buying London trophy assets. They just recently bought More London for 1.3 billion, and they also bought over £1 billion worth of city office buildings. Even though the yields were quite low, they were viewing it as a long-term play. So generally when a Middle Eastern sovereign wealth fund buys in London, that piece of London property almost becomes part of that Middle East sovereign state. And it may not emerge again onto the London market for 20, 30, 40 or even longer in time. And that, of course, in its turn, drives London prices up. So the Chinese and the Middle Eastern sovereign wealth funds still, I think, very interested in central London. We recently had Ping An, the Chinese life insurer, by the Lloyd's building, and various Chinese development funds have bought giant areas of Docklands for over £1 billion and are redeveloping that as a hub for Chinese business. So we've got the sovereign wealth from the Far East and the Middle East still in London, the American private equity houses and the institutions beginning to fan out across the UK looking for better returns. So that's the geographical picture of the UK property market. The conceptual picture is also very interesting. People are looking at, institutions in particular, are looking at identifying the UK's major needs and getting behind those. So if you take what Legal & General are doing, they've identified as two of their key themes ageing population. On average, we're all getting older and we're living longer. And also the residential crisis. We should be building about 250,000 houses a year. The UK is building between 90 and 100,000. That at the moment is an ineradicable crisis which needs a solution. Probably only will be solved by a massive pulse of government and local authority investment and a house building programme similar to those that followed the First and Second World War. But in the meantime, absent that, and it doesn't seem that there's political will for that at the moment, the institutions, such as Legal & General, as I mentioned, in particular led by their very energetic Chief Executive, Nigel Wilson, are lining up behind those crises. And they're beginning to buy things like retirement homes. They're talking about developing major garden city developments. We have done most of that work for them. We manage about 60% of their portfolio in total. And they're also looking at social housing. So we've recently done a £250 million sale and leaseback with Legal & General, with Places for People, the UK's biggest social housing provider, whose job and express purpose is to build housing for poorer people. PFP are going to be building about 11,000 new houses for less advantaged people out of the money that Legal & General have put in. And Nigel Wilson has said that Legal & General have got about 18 billion to put into these long-term projects. The other area, of course, being infrastructure, because as well as UK people having nowhere to live and living a very long time, it's also very difficult for them to get about between things. HS2 is part of that, but also Crossrail. But it's only the beginning. We need new roads, new rail, new infrastructure, new ports, and Legal & General are interested, as are other institutions, in investing heavily into that. So there's a conceptual move to long-term assets that line up behind what the UK economy needs, and there's a geographical move towards areas which can give higher returns.